Do you think the Fed will keep tightening monetary conditions going forward? What will be the implications for this for Bitcoin and crypto markets?
I mean, my view and the view of most of the people I work with at Bloomberg Intelligence is that Bitcoin is a risk asset. Maybe you can the argument it's almost like a call option, a store value asset, or it could eventually be an inflation hedge at some point in the future, but it hasn't been adopted by enough people in our view to truly be those things. I do own Bitcoin, full disclosure, but I don't really necessarily agree with that narrative. So when you go back to what the Fed is doing, the Fed, you mentioned they're hiking rates, we're in quantitative tightening. When you have risk assets, which include things like equities, Bitcoin, quantitative easing, lowering interest rates, pumping money into the economy, adding liquidity, I mean, that is going to send prices higher. And undoubtedly, that was the environment that we were in for a number of years for Bitcoin. Part of the reason Bitcoin went to new all-time highs. It was just a very positive macroeconomic backdrop for Bitcoin because it is a risk asset. So now we're in the exact opposite situation. We just had a 75 basis point hike. We're in for another 75 basis point hike. I think then it's like 50 and then 25 and 25, if I remember correctly. So we're heading for a lot of rate hikes in the near future. And they're not going to slow down rates until inflation starts slowing down. They think there's potential that they can get rates and slow down inflation by raising rates without sending the U.S. economy into a recession. Who knows if that's even possible. That they refer to that as a soft landing. They're expecting to increase unemployment numbers in the U.S. We're in for a bad economic situation, and the question is basically how bad is it going to be? And again, going back to crypto, if they keep hyping rates, they keep raising rates, they're taking liquidity out of the system. Bitcoin thrives on a lot of liquidity. It's a positive thing for Bitcoin. So right now there's a negative backdrop. So if we just look at the macro landscape, it doesn't look great for Bitcoin.
What would it take for the Fed to reverse or pause this tightening policy?
Inflation needs to come down and slow down. But part of the problem is interest rates control isn't like that's not going to control oil prices, which is hurting the U.S. It's hurting global consumers anywhere, and food prices. I mean, so they look at core CPI, which excludes food and oil, which is honestly what's impacting things the most. So the Fed interest rates can only do so much. They can do a lot. One of the other big issues is home price inflation. That's undoubtedly going to be impacted with what's going on with the interest rates. But the Fed's not going to stop until they see inflation come down, I don't think, or something breaks. I mean, if with raising rates this quickly and this much, if something goes wrong in the financial system or something really starts to go haywire, maybe they pause. Who knows? But the consensus from the Fed is basically they're going to hike rates and they're going to start cutting rates again, I think in 2023 or 2024, to bring things down. They just basically want to hike rates, get inflation under control, and then slowly ease off, take their foot off the brake, essentially.
Do you think that, for investors, they have realized that, or have they think now about Bitcoin as not being an inflation hedge? Or what do you think is investors? How do you think they see this?
So I think, like I said, over the long term, there's the possibility that Bitcoin will be adopted as a true store value asset like gold. And like I said, over the long term, gold, over hundreds of years, gold has basically kept up with inflation. People will say, like, you could buy a suit with the same amount of gold that you could buy a suit with today, essentially, a really nice suit. That's the whole store value. But it's not like something that happens like, oh, inflation has ticked up 1% this year, and then Bitcoin or gold is going to go up 1%. It's just more of over a long term. So even if you argue that Bitcoin is going to do those things, it's not a hedge in my mind is something that's going to completely offset it. And maybe it'll eventually offset it over time. But like I said, I view Bitcoin as a risk asset at this point. And maybe the fact that obviously 21 million coins only, all these things, we know exactly how much are going to be created. But again, that's also going to create volatility and price swings, which we obviously have seen for the history of Bitcoin. And I'm not sure. A lot of people say the volatility is going to go down, and it is slowly going down, but it's picked up a lot, obviously, in the last few months. So it has the potential to do all those things that I'm talking about gold doing, but it's just not there yet. And it remains to be seen if it will ever be adopted. But like the one bull case there is that young people seem to think of Bitcoin as a store value asset. They're more comfortable with digital assets than the older generation. So it might take a long time before that gets adopted, but that's just consensus opinion, I think, by most people. As younger people get older and have more money, it might be more beneficial for crypto assets.
Does the narrative about Bitcoin being an alternative uncorrelated investment to the stock market still valid? And what do you think traditional investors feel about this?
So I do think it's largely an uncorrelated asset. I mean, the further back you go, the less correlated it gets. So it's basically becoming more correlated with the global financial system, which you could argue. I mean, you could probably make both arguments. This is not what was outlined in the white paper, or it is what was outlined in the white paper, becoming part of the global financial system. I mean, there's two ways to look at it. One reason is I mentioned Bitcoin and crypto. We'll just stick with Bitcoin for this conversation. I view it as a risk asset, and risk assets tend to move together. So undoubtedly, there's going to be increased correlation as this becomes part of a more regular part of the global financial system. I mean, it's talked about in every financial news network. They're talking about the Bitcoin price. They're looking at it. Everyone's kind of talking about it. You can't write research now without at least mentioning what's going on with crypto, because there's been so much money, so many people interested in it. So that's one aspect of why the correlations are likely rising. The other aspect is there's a lot of similarities between the investors that were in these growth stocks, these names that were up hundreds of percent in the equity market, that are also, so a lot of these names are down over 90% that people talked about, like the Zooms, like what we're on now, Peloton, a lot of these other things that were hyper growth potentials during lockdowns and during coronavirus. And they had a lot of the similar investors that Bitcoin does. So when you have a very similar investor base between two types of assets, you're going to get similar returns, because when they get margin calls or they have to sell or do X, Y, or Z, it's going to affect everything they hold for the most part. So those are two reasons why I think that correlations have gone up. But also, it's not like they're one for one, as many people would make it seem. They are different assets, but it's way more correlated than it has been historically.
So can you explain, technically, why GBTC has been trading at discount since February 2021, despite the fact that we saw all-time highs in Bitcoin price?
I'll try to shorten this up, because I probably need 45 minutes to really explain this, but maybe not. I'll do the best I can. So Grayscale was the first people, they wanted to launch an ETF. So the Winklevoss were the first ones to file for an ETF, but Grayscale went about trying to get an ETF launched as well back in 2013, 2014. And they couldn't get it done, obviously. So they went about, and the GBTC was the first one created. It had a different ticker. I added it to the system as a hedge fund. That's how these things start. They start as private entities or private trusts. They're what's known as a grantor trust, which may be too much information, but to take a step back, GLD, which is the gold ETF, is also a grantor trust. So these ETFs have an underlying legal structure before they file as an ETF or before they become an ETF. Most ETFs are open-end funds, which is a legal entity underneath the ETF. Gold ETFs, silver ETFs, things that hold single assets typically are what's known as grantor trust. So Grayscale from the very beginning basically created these, trying to model it so they can eventually convert it to an ETF, because they knew it wasn't going to happen. So essentially this thing starts as a private placement, which is a private entity that you can only subscribe to if you have a certain amount of money. So when it's like that, you need to be an accredited investor, qualified purchaser, which has requirements on your income or the amount of assets you have. Basically to protect retail investors from just going to any old hedge fund, right? So that's the way all these Grayscale trusts and the Bitwise trust and these other trusts start. They start as private entities. So you have to be basically a PE fund or a high net worth individual, a hedge fund, to be able to put money into these trusts. So it starts, they create the fund. Most of the way the money comes in is people actually give them Bitcoin, right? So if I come in and I give them Bitcoin, they get shares in GBTC, right? So if I'm Grayscale, you come to me with a certain amount of Bitcoin, you give it to me, I put it in, we'll say vault, we put it in the GBTC vault, and in return, you get GBTC shares. Now, one of the reasons why we had such a big premium, which I can't tell you how many people I argued with on Twitter, that this thing could eventually go to a discount. And I just got screamed at saying it was nothing but FUD for literally years. But unfortunately, I was proven correct. But essentially what happens is there was a lockup period. So initially, when you do that, right? So you give me your Bitcoin, you get the shares. For years, it was a 1-year lockup. right? So you can't do anything with those shares. You have ownership of them, but you can't sell them on the secondary market. So what happens is there's constantly being new shares created, but as those shares are created, you're increasing the supply of GBTC. So the way I think about price is supply and demand, right? So as supply goes up, it'll meet demand, but there's a 1-year lag on the supply being created, right? So, and the other aspect of this is there's no way to decrease supply. So supply has only one lever, or only one way. It can only go up in these trusts for the most part. So as people were going in, and then the premium kept going up. So what this was doing was bringing in PE funds, hedge funds that like, look at this 30% premium, look at this 100% premium at times. Let's buy Bitcoin in the open market, give it to Grayscale. And Grayscale was then using Genesis, who's like another part of the digital currency group under Barry Silbert, to then people would hedge the Bitcoin exposure. So they were only doing this basically to get exposure to that premium. And then after a year, they'd sell the shares and unwind their short, and they'd earn that difference between the premium and what GBTC was actually worth. So if it was at a 70% premium when they were able to get out, all of a sudden they took off their short on Bitcoin, they sold their GBTC shares, and they earned 70% on that 1-year lockup. Excuse me. And then, so this other process happened where it's the same process that they lowered the lockup period to 6 months when they became what's known as an SEC reporting company. But again, what it comes back to at this point, what I need to point out is that there was demand for GBTC. It took in so much assets, which people didn't understand was solely because it had a premium. People didn't care. There were people who couldn't care less about crypto or Bitcoin. They were piling into these trusts to take advantage of that premium because it was, I don't want to say merger arbitrage, but it was an arbitrage trade to try and get those special situation returns. There's a lot of funds out there that look for special situations where there's asymmetric return potential. And this was one of those. Eventually GBTC starts trading OTC, over the counter. This happened while it was in the 1-year lockup period. So I skipped that part, but essentially after a certain period of time, they can go through the 144, right? This regulatory process to list their shares on over-the-counter exchange. So these shares trade over the counter. It's normally not that liquid, but GBTC is like one of the most traded OTC securities ever, as far as I'm aware. So basically, when you need to get those shares, you ask for them back after your lockup period, and then you can unload them on the OTC exchange. So again, the premium was being driven by people wanting to take advantage of that premium. And what was happening is basically these high net worth individuals, these PE funds, these hedge funds, were just ripping off retail investors because they were unloading those shares onto retail investors who didn't understand what they were doing and just buying things at 80% premium. But part of the problem is that like people just wanted exposure to Bitcoin in their IRAs, in their other deferred tax accounts. So in the US specifically, you have what's known as an IRA or 401k, but for the most part, it was IRAs, which is basically a way to get like tax advantaged accounts. And there was no real easy way, especially early in like 2015, 2017, 2018. There's a lot of different options now, but back then GBTC was the only way to get access. So you had retail investors who wanted access, buying from hedge funds that were selling to them at like 80% above the value of what the underlying Bitcoin was. So essentially the SEC was just letting this happen. One of the big reasons why we were arguing even in 2018, 2019, the SEC should approve this thing is because it's just high net worth individuals, the rich, taking advantage of people in the retail world. So that was a whole bad situation. So that's why GBTC had such a high premium. And that's why I thought they should allow it to convert to an ETF. Because again, I kind of mentioned before, you can only go one way and there's a lag. So you're creating shares and there's at least a 6-month lag. Sometime earlier in the time, it was a 1-year lag. So you can only create shares. So as demand goes up or goes down, you can't get rid of those shares. With an ETF, it allows for this thing. It's called creation redemption. And the easiest way to describe it is if you have 2 bars, right? You want to have supply and demand equal, because when supply and demand are equal in an arbitrary sense, your price is going to be equal to the value of the underlying holdings, right? So what the ETF does is allows for people to exchange their shares for the underlying, right? So if I can always exchange Bitcoin for shares of the ETF, it's never going to go out of step because there's somebody always going to be willing there to take in and take advantage of that arbitrage, right? They're always going to be able to go in and say, all right, well, if Bitcoin's worth 10% more than the ETF shares, I'll give you my Bitcoin and I'll take the ETF shares because they're equal to each other, right? They're always going to be equal to each other. So that's why an ETF is superior, because there's no delay. You can change supply to meet demand. Well, what happened in 2021, as you mentioned, we saw GBTC's premium collapse into a discount and just keep going, essentially. And that's because, one, we had a few things happen. Mainly, it was the Canadian ETFs were launched. So a lot of institutional investors were using GBTC because if you look at ETFs like Cathie Wood's ETFs and other ETFs and other funds, they are not allowed to buy Bitcoin directly under like the way things are currently handled. So one way around it is you can buy a security. GBTC is a security. So these funds are allowed to invest in securities. GBTC is a security. They can buy GBTC even though it's at a premium, but they can get exposure to Bitcoin that way. All of a sudden, these Canadian ETFs get launched, which is a lot closer to the US than the European ETFs, which are even earlier. But so I think, one, a bunch of money went from GBTC to those ETFs. And then also, as that premium started collapsing, you had a double whammy with the fact that, like, I don't need to stay in this trade of those people who went in there just for the premium. And all of a sudden, they were like, I'm unwinding this trade before it gets worse. So it was like a double whammy of some people leaving to go out elsewhere for their Bitcoin exposure. And the people that were there, not even for the Bitcoin exposure, were trying to unwind out of that trade. So they were just selling their shares as well. So it just basically compounded until everything went down. And again, it goes back to the fact that GBTC is not an ETF. There is no redemption program that can operate right now. So there's no way to decrease that supply to meet the demand for GBTC shares. Part of the problem, GBTC charges 2% a year. It's very expensive. So there's a lot of other issues that go in there, but it comes down to the fact that you can't change the supply to meet the demand. And the demand for GBTC is way lower because people are just like, they're going to use, they use Gemini, Coinbase, Binance, FTX, whatever it may be to get their exposure. If you really know Bitcoin, if you want to stay in the traditional financial rails or use an IRA, some people were using MicroStrategy, all these different ways to get exposure. I think if you're going to do it in that way, GBTC is probably the best structure. But obviously, I think it was a 35% discount on Friday. I tweeted out. So, I mean, that's scary. But the one thing I will say that often gets missed by people looking at GBTC is that if something's at a 33% discount, right, and it needs to get back to zero, it's not a 33% return. So if you think about it, if you have $100 investments at a 33% discount, it's trading at $67. To go from $67 to $100 is roughly a 50% return. So the upside is more than the discount, which a lot of people missed. And actually 3 Hours Capital created a structured note to try and take advantage of people not understanding that, which we can dive into. But that's something also I would point out because I constantly get people that don't understand that. We don't think it's going to be approved. We believe it is going to be denied. And we expect Grayscale to file what's known as an APA lawsuit or Administrative Procedures Act lawsuit. I'm not sure how long that lawsuit would take to play out, unfortunately. But essentially what the APA says, it's the Administrative Procedures Act, and I'll just dumb it down because I'm not an expert on it, but basically you have to treat like situations alike. Basically, the fact that they approved a Bitcoin futures ETF and did not approve a spot Bitcoin ETF is not treating like situations alike because you're allowing for a derivative on a market to trade in an ETF wrapper, but not let the actual spot market trade in ETF wrapper, despite it being a much better scenario for pretty much everyone involved. There's roll costs in futures ETFs. There's other issues. And for the fact that it's just a derivative, you're not actually holding exposure to the underlying asset. That's our view. My view is that, which Hester Peirce said it in her letter in a nicer way, but the way I would put it is Gensler and the SEC are holding spot Bitcoin ETFs hostage until they can get their hands on control of the underlying exchanges in the crypto market. They basically want to get the right to regulate the underlying spot markets. And until they get some sort of leeway or coverage on that front, they are not going to allow a spot Bitcoin ETF in the US to be approved. Now, I will take a step back. Like, I've been pretty critical of the SEC. We could talk into all the reasons why I think a spot Bitcoin ETF should be approved. Issuers have done a very good job. They used to have tons of reasons, right, why they won't approve it. And the issuers have basically hit away at like all of them over the last few years with their repeated filing. A lot of people on Twitter who don't pay attention are like, they're just wasting their time doing this. But if you read through the documents, they've hit away at like a bunch of these different things on why they shouldn't approve that. So like one of them, if we take a step back, you mentioned the futures ETF being approved in fall of 2021, which we accurately called, which we stuck our neck out and actually disagreed with a lot of people. And all we did was read what Gary Gensler said. Gary Gensler basically gave a speech in early August that said, we're looking forward to applications from issuers of futures ETFs based under the 1940 Act. And then we were like, all right, they're going to approve these 40 Act ETF filings. And other issuers literally filed the next day for 40 Act Bitcoin futures F. ProShares had the filing sent to the SEC the next day. Van Eck was like a day or two, like another day after that. So a lot of issuers saw that and started going down that route. But what that did, and the issuers kind of went at the SEC hard, was one of the things that Gensler leaned on, obviously, in that situation was we like the 40 Act because it offers more protections. There are a few things that the 40 Act does that is more restrictive to issuers in what they can and can't do in the fund. And they leaned on the 40 Act because basically GLD, remember I talked about that grantor trust thing a little bit ago, those ETFs they only are under the 1933 and 1934 acts. So basically they have certain restrictions. 1940 Act is basically a higher level of requirements for these funds. All ETFs are required to satisfy the requirements from the 33 and 34, but 40 Act funds also have to follow the 40 Act fund rule. So Gensler was initially arguing one of the big things was we like the 40 Act protections, not the 33 Act, which is, in my opinion, a little ridiculous. I mean, GLD is a 33 Act fund. There's tons of 33 Act funds out there. And eventually that got whittled away with Türkçe, which just got approved this spring, was a 33 Act futures ETF. And the SEC was basically, I wrote about this, the title of my piece was the Türkçe filing has put the SEC between a rock and a hard place, because either they approve the futures ETF because they already approved a futures ETF and the 33 Act and 40 Act aren't different enough to really satisfy the idea that one is better than the other when we have tons of 33 Act ETFs, or they don't approve it, and then that's a blatant APA violation, essentially, and they're going back on their word of what they said, why they would approve it, the fact that the futures market is a regulated market. So the one thing they keep going back to, I was critiquing the SEC, every time they've said they want a surveillance sharing agreement with a market of significant size of the underlying spot Bitcoin markets when they approve a spot Bitcoin ETF. So basically, they want a market that's regulated by the CFTC or the SEC, or they want these exchanges like FTX, Coinbase, Gemini, Binance, whoever it may be, to send surveillance sharing agreements with the exchange it's listing on. So New York Stock Exchange or NASDAQ, so that if a regulator comes in and wants to figure out what happened, they can see all trades that ever happened on those exchanges, which one is extremely expensive for those exchanges to send to other people. Like they don't really want to open their books. Obviously, there's a lot of shady stuff that happens in crypto. So depending on who you are, you might not want to do that. So the SEC has leaned heavily on this surveillance sharing agreement requirement or a regulated market of significant size, which they haven't truly defined. So once that happens, that's when a spot Bitcoin ETF gets approved. And no matter what anyone else says on Twitter, if we get to the fact where there's an underlying spot market of significant size that's regulated by the CFTC or the SEC, or there's serious surveillance sharing agreements, we will get a spot Bitcoin ETF approved.
The bill is basically giving CFTC more power to control spot exchanges, and that you actually mentioned that Gary Gensler wants more control in the exchanges too. So there's actually some divergence there, giving some role to SEC as well. But for the spot exchange controls, like regulations, actually intended to be given the CFTC more. So that's why I actually wanted to ask this. If this bill goes forward like this divergence between SEC and CFTC on regulations on crypto industry assets, basically, is this in line with your trajectory for the spot ETF approval?
So the exchange definition thing, so I'll take a few steps back. One, the first thing I would say is part of the reason why we think it'll happen in 2023, if I had to put a date on it, I'd probably say the second half. I mean, we could see surprises where things happen, that it happens quicker. One of those things is the bill that you're talking about, which I'll dive into as well. But if we look to the exchange rule, basically, the rule that we wrote about, it's Gary Gensler, in our view, basically just wants, first of all, he wants to be the Treasury Secretary of the United States. It's basically like an open secret. He's a political animal. He's a politician, essentially, and he wants to get a higher level position than just chairman of the SEC. And we think, and I think a lot of people agree, that Gary Gensler wants essentially to be able to say, I team the Wild West of crypto on his resume when he goes up. And one of the other things is he can't anger or aggravate the people like Elizabeth Warren and the other senators who are very anti-crypto. Some of it, they seem to be toning down their language of where they were a while ago, but there's a lot of people that were higher up in government, especially people during Trump's administration, that were very anti-Bitcoin and anti-crypto. So Gary Gensler is obviously trying to do two things. One, he doesn't want to anger people on either side too much, which I think he's failing at, because no matter what he does, he's going to anger one side. But he's basically trying to be a politician, and he wants to, like I said, get on his resume that he took care. He cleaned up the Wild West, essentially, of crypto. So going back to the exchange rule, basically what the SEC is doing, and this is before, this proposal was many years ago, and it's just now like it's in the works. It's going to expand the definition of an exchange. Honestly, the number one thing I think it could do is like DeFi protocols would automatic, like under this new definition, would likely be considered to be an exchange. The other aspect is the definition of an exchange doesn't really need to change for crypto exchanges to become what's known as exchanges or alternative ATSs. They're alternative trading systems. And that would also, they have to register with the SEC to do that, right? So no matter what you do, you have to register with the SEC. The main thing that would happen, even without changing the exchange rule, without broadening it, is if they start naming a bunch of these tokens and cryptos as securities, it's the SEC, all of a sudden, they already are exchanges. And Binance, FTX, anyone operating in the US, Coinbase, has to register as an exchange or an ATS. So that would be one way that could happen. But obviously, we've seen with Ripple, it's not that easy just to call something a security. I mean, how long is the Ripple litigation going on? So it's my opinion that we likely need to see something come from Congress, like the Loomis-Gillibrand bill, that brings us into another area. So one, I'll just say, if some of these things start getting called securities, basically these exchanges are probably going to have to register with the SEC because they're trading securities as far as the federal government is concerned. And honestly, if you're an exchange, maybe you let these underlying crypto companies or tokens fight that argument. But basically, if the SEC is providing enough pressure on these exchanges to start doing this and saying these are securities and we're going to start litigation and lawsuit, like all of a sudden, if it becomes more expensive to fight that litigation, than just register as an exchange, which is money. It's expensive to be an exchange and register as an alternative trading system and do all these things that are required by the federal regulators. Then all of a sudden, maybe more people will come on board and just become regulated. The thing with the Gillibrand bill goes back to the other piece that I wrote in May. And I titled it, the FTX's CFTC proposal could be backdoor to a spot Bitcoin ETF launch. So without going in too wonky into the way that things work, CFTC has a proposal in front of FTX has a proposal, too many acronyms. FTX has a proposal in front of the CFTC, which, to take a step back for people that don't know, the CFTC is the Commodities Futures Trading Commission, which basically is in charge of commodities and futures and all these different things. The SEC is the Securities Exchange Commission, which is in charge of securities. So think stocks, bonds, things like that. And they're supposed to work in tandem. They often butt heads on a lot of things. They're particularly butting heads a lot over crypto at this point. But FTX's proposal to the CFTC would basically be real-time monitoring. Usually there's margin, the way there's margin trading with, I don't want to get too in the weeds here, but if you're using futures, you're using margin trading, there's leverage automatically involved. And FTX wants to change the way that works, right? So that you can post collateral and do things that will be real-time monitoring. It'll be more automated than the current system is done with the CME, which is where the Bitcoin futures are. FTX wants to have its own futures, its own futures exchange, essentially, in the US. And without getting too in the weeds, basically what happens is they want the CFTC to okay this and allow for another model than what's currently legally allowed. Now, the key thing here is that one thing that FTX wants to do is be able to offer anyone leverage in trading spot and futures markets, right, on their platform in the US. And there's this thing under the Commodities Exchange Act, which is another regulatory act, but it's this one section, 2C2D, retail commodity transactions is what it's called. And basically, if anyone is entered into or offered to, even if not entered with, a person that is not an eligible contract participant, which basically means retail, it qualifies as retail commodity transactions, or if they're offered or even entered on a leverage or margin basis the counterparty or person acting in concert, blah, blah, blah. So basically all this language is saying is if you're offered, even if you don't take it, to be able to use leverage in a commodity transaction, which basically CFTC, even Gary Gensler admitted Bitcoin is essentially a commodity. It's considered a retail commodity transaction. Retail commodity transactions fall strictly under the purview of the CFTC. So if this proposal from FTX gets approved by the CFTC, all of a sudden their spot markets are a CFTC regulated market, right? So then it satisfies those agreements. So that's one area that I think if this gets approved, that's another way we could potentially get an ETF. But again, it has to be a market of significant size. It's likely that initially FTX's spot market is not a market of significant size as far as the SEC is concerned. But if other exchanges start following this path as well, who knows? It's just another way.